In this video, stocks rebound big time as the market remains volatile, Tesla halts production in Shanghai, a Wall Street stock analyst admits to massively underestimating Tesla, and says the stock will gain over 50% soon, plus a very bullish new research note on Tesla. So let's get into it. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. Rarely a dull moment with Tesla stock. We can see here the 52-week low, $546, the 52-week high, well over $1,200 per share. Today, Tesla stock up almost 5%, closing over $840 per share. But just to put things in context, year-to-date Tesla stock still down about 30%. What the actual fuck? Broadening out a little bit, the flagship ARK fund, ticker ARKK, up over 10% for the day. The bell curve continues to be real. Rivian stock gaining over 12% today. Fraudstown Motors almost 10%. Lucid about 7.5%. Amazon stock today gaining over $100 per share, up almost 4%. And Alphabet/Google up over 3%. As we can see, the stock market remains extremely volatile. One day maybe a violent swing down, the next day maybe a violent swing up. But I'm not going to complain. The more buying opportunities, the better. And now onto Tesla's Shanghai production shutdown. We've just learned, quote, Tesla halts Shanghai EV production for 2 days. Elon Musk's Tesla halted production at its Shanghai plant for 2 days after Chinese authorities tightened plague restrictions to prevent the plague from spreading, according to Reuters. By the way, their efforts will be in vain, but that's another topic for another video, probably on another channel, and most definitely on another platform. According to a notice delivered internally to suppliers, the electric vehicle maker is set to stop production on Wednesday and Thursday at its Shanghai factory, which normally operates around the clock. The Shanghai plant produces Tesla Model 3 sedans and the Model Y crossover sport utility vehicle and represents one of Tesla's key export hubs to Germany and Japan. The factory manufactured 56,515 vehicles in February, 33,315 of which were delivered for export. The good news is that this entirely unnecessary forced factory shutdown is only for 2 days of the month. It's not going to make a major impact on overall production. I mean, do the math here. 2 days out of a month, you know how to use a calculator, right? Not a big deal. Multiple cities in China have been tightening plague restrictions in a vain attempt to curb the latest outbreak. The measures have also resulted in factory shutdowns, weighing additionally on supply chains. So this is something that may impact Tesla to a degree as well. It's not just that their factories have been shut down, but some of their suppliers as well. It remains undisclosed whether tighter restrictions would mean a loss of production for Tesla or if the car maker would be able to compensate for that loss. Well, I mean, if they're shut for 2 days, they're not making those vehicles. They can't catch up because they're already making vehicles at maximum speed. One final line that really stood out in this article here, maybe something lost in translation, but probably not. Quote, furthermore, the car maker, as in Tesla, also asked suppliers to make preparations and enable workers to live, sleep, and eat at the factories. I can understand why this would be an idea. If authoritarian lockdowns are being imposed on citizens, why not have them locked down for a few days in factories so they can keep producing products, materials, parts, and contributing to the economy? Sounds like Tesla's pretty serious about accomplishing their mission. Next, an extremely bullish new research note published from Morgan Stanley, including an admission that they massively underestimated Tesla. Surprise, surprise. By the way, Morgan Stanley, if you're watching, I suspect in the future you'll probably be saying the same thing. Oh, we underestimated Tesla. Again, and I just wanted to quickly share a tweet from Philip Engberg here. This is a visual representation of Tesla price increases over the last year, give or take. If you want to pause the video, I recommend it. Have a look, but just visually, I just want to show the trend here. We're looking at the 3 different models of Model 3 here. Trend clearly up. This will lead very nicely into the new note published by Morgan Stanley. You can see the same thing, Model Y, however, it's a much steeper price increase. Why might that be? Spoiler alert. Even more demand for the Model Y than there is the Model 3 and less supply. Model Y well on track to becoming the world's best-selling vehicle, first by revenue, then by units. And Tesla has amazing pricing power and enormous margins. Now we look at the Model S, the long range, and the Plaid. Again, huge trend, huge price increases over time. And of course, the Model X also heading to the moon. This is bullish. I've talked about this in recent videos. The long story short, The fact that Tesla can and is continuing to raise prices because they don't want wait times to get too ridiculous, and wait times are still ridiculous, shows the truly insane level of demand for their products. So Morgan Stanley have just toured Tesla's Fremont factory in the United States, and by the way, it's definitely not the same Morgan Stanley who recently, just a few years ago, had a $10 bear case price target for Tesla stock. By the way, that was pre-split, so split adjusted a $2 bear case for Tesla stock. That was definitely not them. This is a totally different organization. So with that said, let's read what they've got to say. Straight off the bat, $1,300 price target, meaning more than 50% upside for Tesla stock from where it is today. Quote, "We toured the Tesla Fremont factory on Tuesday, March 15th, test drove the Model 3, Y, and Model S Plaid, and attended a meeting with investor relations. Our key takeaways are below. 1. The Tesla Fremont plant is bustling, to say the least. The plant was never designed to produce 450,000 units. At its peak, it produced around 300,000 units before Tesla took it over from Toyota, which was immediately apparent at the tour. Tesla does not shy away from the fact that the plant is inefficiently designed, with 4 assembly buildings, one of which is a tent that cars are assembled in. In addition, the battery cell packaging process is done at the Nevada Gigafactory, which brings a host of logistical inefficiencies." Absolutely nailing it at this point in time. For those that don't know, Tesla bought this factory for pennies on the dollar. Bargain of the century. Downside, of course, is this wasn't a blank slate design, so they've had to adapt and adjust and work with what was there. This is why it's quite inefficient. This is why margins from vehicles produced in Fremont aren't as high as those in Shanghai, won't be as high as those in Austin, and won't be as high as those in Berlin. This is also why it's important over the long term for Tesla to be producing battery cells on site at each factory they're producing vehicles. The note goes on to say manufacturing in California also has much high costs, including labor. The plant is also running out of space, which was notable, and provides little space for trucks to drop off supplies in locations that make sense inside the plant. In other words, Tesla's really squeezing every ounce of productivity out of this factory. They're doing their best, but they're really bursting at the seams. In the office building within the plant, there's an exciting buzz with 10,000 support personnel across HR, accounting, engineering, and other supply chain functions. In the plant itself, we saw bustling traffic with forklifts beeping and weaving their way through traffic, all busy ramping up the 3 and Y for North American deliveries. And as you guys can see on screen now, the enormous inefficiencies of Fremont versus the Shanghai factory. Shanghai has ample room for trucks to drop off supplies to each relevant area of the plant. It's a linear process, whereas Fremont, it's just an absolute clusterfuck. 2. Tesla is demonstrating strong pricing power. This is a big understatement. The comparable standard Model 3 trim model was around $36,000 a year ago, and today starts at approximately $47,000, up around 30%. While the standard range Model 3 has appreciated the most, other models have driven 5 to 8K also. Tesla is raising prices from a position of strength, bingo, and is still not seeing wait times go down. Also, bingo, and also a very important point. Tesla's current wait times ranging from 2 to 3 months to 6+ months depending on the model. This really is insane. To think that Tesla has raised prices 9, 12, 15, 20, up to around 30% on their vehicles over the last 12 months, and that the wait times are still approximately the same as they were a year ago, is insane. And importantly, quote, "If one purchases a more expensive trim model with full self-driving, which is basically $12,000 of pure profit to Tesla's bottom line, Tesla is beginning to prioritize these shipments with earlier delivery, which is going to have a massive impact on margins in the next couple of quarters." Tesla believes that supply-demand dynamic will persist for the next 18 months at least. Now keep in mind, this is Morgan Stanley sharing notes after having had a meeting with Tesla's investor relations. Morgan Stanley clearly sharing an insight they learned from Tesla directly. Tesla themselves believe that the supply-demand dynamic will persist for the next 18 months at least. Tesla is able to utilize this period given their superior value proposition for customers to layer on further pricing. Quote, "We had underappreciated the pricing power." Imagine that. Morgan Stanley, any Wall Street stock analyst, underestimating Tesla. Again, there's definitely no videos of me 2+ years ago on the internet saying that Tesla's margins would march steadily towards 30 and then ultimately 40%. You definitely will not find those. So obviously this is very surprising, and I totally don't blame Morgan Stanley for massively underestimating Tesla. "We had underappreciated the pricing power and the lead that Tesla has, and expect Tesla won't need to cut prices until 2024 or 2025 to maintain its market share." We got to talk about this. So let's say Tesla doesn't need to cut prices till around 2025, about 3 years from now. Just some ballpark numbers. How much do you think Tesla will be able to reduce the price of producing their Model 3 and Model Y over the next 3 years, factoring in things like economies of scale? The very fact that Tesla's producing 5, 6+ million vehicles in a few years' time versus today means they can order many more parts, 5 or 6 times as many of the same parts, because parts are used in common. This means they can buy those parts for a lower price. In short, the more vehicles Tesla produces, the more they can buy in bulk and the cheaper they buy for. Pretty simple. But in addition, Tesla continues to innovate in terms of manufacturing techniques. They keep finding ways to delete parts processes. In the next few years, Tesla could easily drive the cost of producing their vehicles down by 3, 4, 5, 7, 10, 15+%. Just imagine hypothetically that the price for Tesla to produce a vehicle falls by just 10% over the next 3 years. I expect it's going to be much more than this, but hey, let's be conservative. If the price to produce the vehicle falls by 10%, but Tesla doesn't need to cut the prices, this means their margins are going to inflate enormously. Tesla could move from having gross automotive margins around 30% to around 40% just based on innovations in manufacturing and economies of scale. Tesla already has industry-leading profit margins, making 2 to 3 times more than most other automotive manufacturers on each vehicle sold. This statement from Morgan Stanley has profound implications. This is unbelievably bullish for Tesla. Of course, I agree with what they're saying, but to hear Wall Street stock analysts going, oh, hang on a minute, seems like they have a lot of demand, and their margins will probably keep going up. That's pretty good. More importantly, Morgan Stanley pointing out that by the time Tesla does need or potentially need to start cutting prices to maintain their obnoxious 25-ish% market share, which itself is obscene, by then the software can contribute more to the profit and loss, obviously. More utility in full self-driving, higher take rate, bigger profits. This is absolutely spot on. I think what Morgan Stanley are trying to say here is that Tesla is a money printing machine today, and they're going to be massively ratcheting up that money printer in the next few years. Huge margins, huge lead, insane demand, crazy wait times, software an even bigger component of overall profits. Saying that, we still believe that it remains Tesla's mission to invest its margin into lower and lower prices to expand the addressable market for EVs at entry-level segments in developed markets, as well as expanding into ultra-low priced emerging markets like India. Long term, totally agree. Tesla, obviously, what is the job of the engineers at Tesla? Delete parts and processes, reduce costs, make things better. Pretty simple. So of course Tesla's going to continue to drive the cost of production down and have the ability to lower prices to massively expand demand. But Tesla's doing so from a position of strength. There'll come a point in time, and I don't know what the price point is, but there will come a point in time where the value represented by a Tesla vehicle is so enormous versus the purchase price that Tesla won't need to lower prices beyond that point, and they'll sell literally tens of millions of vehicles per year. When I model it with my Tesla price target and valuation model, I'm extremely bearish. I assume the average selling price falls off a cliff, but I don't think that's what's going to happen. After all, if there's enough value provided by this product, this service, it doesn't necessarily come down to cost, but value. 3, raw material impacts is felt, but not at the rate of pricing increases. I love the jargon here. Raw materials has now become raws. Raws aren't keeping Tesla up at night. I'm sure there's a joke about raw material keeping people up at night here, but we're not going to go there. Let's move on. Chips are actually a bigger concern in real time. Tesla has long-term contracts in place, doesn't specify the exact percent, blah, 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 and is already feeling commodity pressures, which was in the Q4 result, and it should not come as a sudden impact to margins, in our view. In addition, as we start to lap periods of higher prices from September last year, and only recently this week after layering in further price increases, this will more than positively offset any headwinds in later quarters. Morgan Stanley effectively talking about the price increases over time, the wait times, customers are paying the prices at the time they put their order through. So these price increases have actually been happening over the past 12 months, but are only starting to roll into Tesla's financials in recent quarters because customers have been waiting 3, 6, 9, 12 months. Tesla is not worried on nickel given their reliance on LFP for 50% of models today for standard range, which doesn't need nickel or cobalt, commodities whose prices are going through the roof at the moment. And going forward, LFP could move to 60 to 70% of units if needed if nickel becomes uneconomic. Near term, the key challenge for Tesla being chip supply. 4, capacity and margins. Tesla reiterated its guide to be comfortably above 50% volume growth with or without Berlin and Austin. As the CFO mentioned on the conference call, the key impediment remains chips, not cells or commodities at this point. Tesla has been creative by recalibrating software to rely less on select chips and took out chips for things like lumbar support, blah, blah, blah. The ramp of Berlin and Austin also posed some interesting dynamics on margins. On the one hand, lower initial fixed cost absorption and lower cap utilization will detract from margins. For those of you getting a little lost in the jargon, basically there's certain fixed costs that get divided by the number of vehicles you produce in a factory. The less vehicles you're making initially when you're ramping up, the higher the fixed cost attributed to each vehicle, meaning you've got lower profit margins. On the other hand, more efficient design and less reliance on Fremont is a positive. Again, because Fremont is an absolute clusterfuck, it's extremely inefficient, so this is a very true point. Delivering cars in the country/region of the plant also leads to cost advantages. Obviously, you don't have to ship them halfway around the world. Tesla also mentioned the Model Y shares 75% of the common components as Model 3 and costs similar to make. Further, Shanghai has 65% less capex per unit of capacity versus Fremont, meaning effectively that it costs Tesla a shitload less to build the factory in Shanghai versus Fremont compared to how many vehicles it can produce. They're getting much better bang for buck. Moving to a structural battery pack and from 2170 cells to 4160 cells will also lead to a 50% cost reduction in batteries long term. Here's an epic insight. Tesla also reduced assembly steps in Shanghai from 100, what other OEMs typically have, to only 45 steps. Talk about deleting parts and processes. As Elon said, the best part is no part and the best process is no process. And reduced the welding line from 1,000 robots in the Model 3 to 300 in the Model Y, and is continually looking for manufacturing efficiencies and for less capex in the plant. Tesla learned from over-automating the Model 3 launch in Fremont, but also still writes its own code on their robots to allow more seamless changes when needed, which also makes them less reliant on robot vendors for changes. Tesla really taking destiny into their own hands. This gives them incredible agility and adaptability. Tesla emphasized its leading motor, inverters, and BMS as key drivers of battery efficiency. By the way, battery management system, I'm assuming. In addition to their battery cells that they now source from the leading 4 battery companies, Tesla Investor Relations also mentioned that it believes the industry is grossly undersupplied across capacity and all other adjacent bill of materials in 2025 if we believe OEM projections, and if EV adoption remains strong to around 25% in 2025, Tesla should be in a key position of strength to capture meaningful amount of EV demand. And last but definitely not least, number 5, full self-driving impact. While not disclosed, investors believe the take rate for full self-driving is approximately 15% in the US and in the low single digits in other regions. Once Tesla releases an updated citywide full self-driving, the accounting will change. This is hugely important, well, at least if you own Tesla stock. Instead of 60% of full self-driving revenue being recognized immediately, with 40% deferred, Tesla will be allowed to recognize all of its full self-driving revenue up front. This is massive. The impact of this on 500,000 cars in the US, approximately 1/3 of its 2022 deliveries, at a 15% take rate and 40% incremental recognition at $12,000, the cost of full self-driving, is approximately $360 million of incremental pre-tax profit realized. No longer having to defer some of that full self-driving revenue is an extra $1/3 billion of profits in a single year. Something to think about. And has the potential to boost margins by a shitload. By around 40 basis points structurally going forward. Tesla stressed autonomy as an AI problem and is looking to train its neural network over time, layering on real-world mileage data as it accumulates. And wait for this one. We note that while our Tesla stock price target includes average revenue per user for the network services business and recurring revenue from Tesla Mobility, human-attended rideshare, we do not ascribe any specific value to Tesla from full autonomy, as we believe the technology will not be ready to deploy at scale for many years, i.e. a decade or more. Morgan Stanley, huge autonomy skeptics. I personally believe they're way too bearish and way too skeptical here. I expect that robotaxis will begin to be deployed in a widespread form sometime around mid this decade, not 10 plus years from now. Of course, I could be wrong, but that's my expectation. I personally think the very first robotaxi fare in a Tesla anywhere on Earth will happen in 2024 and begin scaling from there. But the real point here, Morgan Stanley, with a 12-month price target on Tesla stock of $1,300 per share, ascribing no value whatsoever to Tesla autonomy because they don't believe it's happening anytime this decade. Something to think about. So to recap, stocks rebounding today. Who knows what happens tomorrow? Morgan Stanley admitting they massively underestimated Tesla in terms of demand, margin, pricing, everything, but the penny is starting to drop. Some extremely bullish comments and some new insights from Tesla after Morgan Stanley toured the Fremont factory and met with Tesla Investor Relations. In short, Tesla, which is already a money printing machine, is going to ratchet this up to a whole other level. Hope you guys enjoyed the video, and don't forget to sign up to Patreon with the card in the corner or the link in the pinned comment, and you'll instantly gain access to my Tesla price targets. They're always up to date, includes a bear case, base case, bull case, and a hyper bull case all the way out over the next 10 years, right up to 2031. And you'll also gain instant access to over 100 exclusive Q&A videos on all sorts of topics. So I'll see you over there. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.